Hey guys, and welcome back to yet another video in the 365 Days of Forex series. Today we'll be examining the very interesting topics of liquidity pools, order flow in the market, and why there's a fear amongst retail traders of Mark, head trader at Morgan Stanley, going after their stop losses. And we'll also be giving you a nice and neat basis for a trading strategy right at the very end of this video. So without further ado guys, let's get into today's video. Most of the stuff we'll discuss today is based on the Wyckoff methodology, which will actually be discussed in another video on Friday. If you're enjoying the 365 Days of Forex series so far, then please give the video a like, consider subscribing, and maybe even turn that bell notification icon on so that you get notified when we upload videos. Also, if you do want us to cover anything again in the future in later videos, please drop a comment below and we'll make sure we get that covered for you. Let's now get on with the video by first looking at what liquidity actually is. Fancy seeing you here. It's Jack from the future because my camera decided it didn't want to record this part of the order flow video when I tried to record it 2.5 weeks ago. So I'll just take this a little bit from here. Liquidity usually describes how easy it is to convert an asset into cash without taking a large hit on the value of the asset. With this in mind, it's important to remember that in Forex, our trades can be matched by a party taking the opposite position as us. If you want to buy GBP/USD at 1.3, you need someone to be willing to sell GBP/USD at 1.3 also. If there's no one willing to sell at 1.3, the market will find the next available seller, which will be at a point slightly higher than 1.3. This will just be the slippage, and that is the difference between these two prices. This is just the basics of how the markets work. Therefore, the best way to define liquidity is essentially how fast you will buy or sell an asset in the market without experiencing massive amounts of slippage. Or in other words, how easy it is to find someone to take the other side of your trade at the price that you want to enter. Liquidity goes hand in hand with volume in the market, and that is consequently why traders often gravitate to the Forex market due to the large liquidity when compared to markets like the FTSE, which is a thin market comparative to the most major FX pairs. This means that larger traders will often struggle to execute large positions in the FTSE without seeing a large variation in the prices that they've been filled at. But with that being said, Forex won't have any issues, and that will just mean that you won't get slipped even if you are a larger trader. With this idea of liquidity, we now need to look at where liquidity is in the market, otherwise referenced as a liquidity pool. These liquidity pools are often points in the market where a large number of traders may need to make a decision to either open new positions or close existing ones. The most common liquidity pools are either on the other side of a range, as orders will be accumulating here to take advantage of the breakout, as people will want to get right at the source of the new exciting trend. Another special mention of areas that have a high probability of being a liquidity pool is at a major swing point in the market. Places where it's clear the trend is going to continue, either when a major high is breached in an uptrend or a major low in a downtrend. Of course, there will always be traders looking to capitalise on the start of a new trend too, and try and pick out tops and bottoms in a classic retail trader fashion. As a result of this, areas where a trend is seen to be broken, for example breaching a major low if an uptrend or a major high in a downtrend, will also be likely areas where orders will accumulate. So I'll hand you back over to old version of me to continue this video and talk about why liquidity pools are important. Even if a large institutional trader wants to trade in the exact same direction as all the retail traders, they can take advantage of triggering large numbers of stop loss orders to get even more size in their position by sitting their hands just a touch longer. Put simply, it's impossible to avoid liquidity pools, so your best hope is to minimise the chances of you falling sucker to them. Luckily, we've got a few good ways to do that, and they're actually relatively easy to adhere to as they're the foundations of becoming a profitable trader. The first method is to always trade with the trend, as larger traders tend to trade with the trend and establish larger positions into the market, as they can't chop and change at a moment's notice due to the size that they're trading with. This being said, by trading with the trend, you can usually avoid some of the headache if you stop being hit by one pip, only for the price to rocket and hit your initial TP. The next method is through using wider stops when first using your strategy. By not placing your stop loss 2 pips below a prominent swing low, and instead 10 to 15 on a lower volatility pair or 20 to 30 on a higher volatility pair, you're much less likely to fall victim to liquidity pools. One of the main reasons that you keep a trading journal is to see if you can actually use tighter stops in your trades. It's a lot easier to see if you could have used a tighter stop rather than a wider one. This leads us nicely into the third way: always backtest your strategy. Although this is a bit of a cop-out method, if you adhere to the 2 criteria previously discussed and you know that your trading strategy is profitable, despite liquidity pools being present in the market, it begs the question, do they really even matter in your trading? The answer is not really, and that is because you're still profitable despite their presence. Now we've taken a look at liquidity pools, let's look at order flow and why knowledge of this is incredibly important. A lot of traders try to understand the concept of order flow and simply end up becoming paranoid, thinking that John on the trading floor at Goldman Sachs is watching his screen waiting for a buy order to enter the market so he can fade it. However, this is most definitely not the case. Order flow is simply the mechanism that moves price in all the financial markets, and on a basic level it's just the interaction between supply and demand. All financial markets move as a direct result of buyers and sellers entering and exiting the market, or in short, just simple supply and demand. Just imagine you have a really rare item that you take to an auction. You're the only seller of this item and there are 100 buyers sitting and waiting to bid on your item. As you can imagine, prices will climb due to the high demand for the item compared to the relatively short supply because there's only one of you and 100 buyers. If we flip this scenario on its head and imagine that you're now looking to buy an item from an auction and there are 100 sellers supplying these goods, the likelihood is prices will decline for the item as the demand for the goods they're selling is small due to there being more sellers than there is buyers. Although order flow is hard to quantify in the Forex markets, what we need to be aware of is how this concept of supply and demand can be seen in the market and the different methods that can identify buy and sell liquidity in the markets. Let's take a look at this example here. As you can see, prices are at a level of support and a lot of traders will be looking at this area to go long and buy the asset. If at this point the number of buyers, or strictly speaking the total volume of buy positions entering the market at this point is greater than the sellers, then price will just move up. Similarly, if we look at the next example, we can see if prices reach a previous level of resistance. If the volume of sell positions outweighs the volume of buy positions, we will again see prices to reverse and decline. So a light bulb may have just gone off in your head and you might be thinking, should I just sell at key levels of resistance and go long when price action meets a key level of support? And the quick answer, and before you hit the trading view, is no. But it's better to understand why you shouldn't do this rather than just no. To further understand why this won't work, we need to peel back another layer of order flow and we need to look at the mechanics of an actual order in the markets. As you may know, if you want to buy an asset, you need to have an equal volume of orders from traders who want to sell the same asset at a similar, if not the same price. This doesn't necessarily mean that you have to be matched with a trader who fills your complete order, but it might be the case that you want to buy JPY at 138.50 with a 10 lot size position. You're matched with 10 traders who are looking to go short of this position with a 1 lot size position each. This would equate to 10 sellers and 10 buyers in terms of lots volume. This process of matching your position to another trader is extremely fast, and providing that you're trading in a thick market, such as the FX market, the likelihood is there'll be minimal, if any, difference in the price that you wanted to enter at and the price that you were filled at. Whilst you may then be wondering why the concepts of order flow and liquidity matter if your order is going to be filled almost instantly, you need to think of the bigger picture. I mean, the really big picture. The picture that depicts institutions whose traders are executing 1,000 lot trades on a regular basis. These traders not only want, but need to get filled at the best price possible when they've identified a level that they want to do business at. It is no good if the trader looks to get involved with a small retracement of 50 pips if the order will be subject to huge slippage due to a lack of liquidity. To combat this, the larger traders will identify liquidity pools in the market. As discussed earlier, these are areas where there are a large number of orders being entered into the market, and often we can see this with our volume indicator as volume increases consistently towards these areas. As I said, the liquidity is provided by orders, but often a lot of traders don't actually understand the different types of orders and which side of liquidity they impact when they're triggered. If you enter a buyer position in the market, you will have been matched with someone who decided to sell their position at the same or similar price. And when you want to exit this position, you'll also be required to sell your position back to the market, meaning you'll be matched with someone who is buying the asset. In liquidity terms, this means that you've essentially created liquidity for sellers when you open your position, and when you want to close out your position, or it's stopped out, you'll be creating liquidity for buyers who want to also then enter the market. Alternatively, if you enter a sell position, you'll be matched with someone who's entering a buy position at the same price. Once you decide to close this sell position, you'll essentially have to buy the position back. This is because when you're in a sell trade, you're actually taking part in a complex process, which, in short, requires you to buy the position at a lower price once closing the position in order to profit from the difference. Of course, if your position goes against you, you have to buy the position back at a worse price. In this case, the difference would be your loss. If we then look at this once again relative to liquidity, when you're in a sell position, you'll be matched up with a buyer or multiple buyers, meaning you've created buy liquidity with this position, as traders are able to take the opposing side of your sell trade. When you close the position, you need to buy the position back, and at this point, traders are able to use this buy liquidity in order to open sell positions. Now, although this may seem super complex, it's really important that you understand the mechanics. Larger traders are aware of this and often will use areas of high liquidity, which are exactly what liquidity pools are, to enter the full position so that they're filled at the same price that they intended to enter at. This is likely why when you start trading, prices always seem to go up to your stop loss before continuing to reverse and move in the direction that you planned. This is not a coincidence, rather large traders identifying the same levels in the market as you are and waiting for the less experienced traders' stop losses to be activated in order to be able to take advantage of the liquidity to enter their huge positions. Let's head back to the computer and take a look at an example. As we can see, price has broken through the recent swing point with a piercing candle, closed below and then headed down in the original direction, almost like a double top. What has occurred here is that larger traders have used this area of liquidity, in particular the liquidity pool just above this recent swing high, to enter the market. As we spoke about earlier, if a sell trade stop loss triggers, it's essentially providing buy liquidity to the market. Therefore, larger traders will target the area at the swing high, where they know lots of retail traders will have placed their stop losses, and then use this buy liquidity to execute sell trades of their own. At this point up here, price will push through and take out the stop losses in the market from all of the traders who sold early down at the support. These stops have been taken as buy stops, which means that there is a lot of buy liquidity that can be used by traders who want to enter sell positions. If price takes out these stops and then forms a quad play candle, i.e. we break the highs and then close just below, it's usually a huge indication that a larger trader used the liquidity to enter his own position, and price will reverse and go to the downside. So guys, that about wraps up this order flow video, and for me personally, this is probably the most exciting topic in trading, apart from maybe HFT trading. If you did enjoy the video, then make sure you subscribe, like, and all those things that are good for the YouTube algorithm. And with that being said guys, cheers, and I will see you in the next one.